and approaches. Unit 6 of Block 2, Management of Marketable Securities. In the introduction part, let us just understand what are the marketable securities. Cash and marketable securities are normally treated as one item in any analysis of current assets. It is holding cash in excess of immediate requirement means the firm is missing an opportunity income. So what do? Excess cash thus is normally invested in marketable securities, which serves two purposes. First, provide liquidity and also earn a return. Okay. And second one is marketable securities form a major component of cash and marketable securities. Why? Because these are short-term investments because of the liquidity concerns. Investing surplus cash in marketable securities is normally a part of overall cash management. As I have already told you, it becomes a separate activity of the firm because holding the cash, the motive of cash, and then over and above the holding of cash, we are investing them also in the short-term securities. So if the investment in marketable securities form a major part of the current assets, many firms in India today are very active in money and capital markets where marketable securities are traded, because this is the prudent cash management. Why do we need investment in these securities? Marketable securities result from investment decision that really are not main part of the firm's business. You see, we are not the investors and we are not inviting investment as well from the other players. So it is not the main business. Still, it is a cash management technique. It is a cash management strategy. It is a cash management skills. But marketable securities cannot be ignored. Why? Because they constitute a part of value of the firm that is entrusted to management. Another prominent reason for holding marketable securities is on account of mismatch between the borrowing and investment program. Now, there is a gap between the borrowing and investment program. So we have some cash in hand with us, which we are not willing to go for a long-term investment. So definitely that gap, we are just using it for the marketable securities, for the short-term investments. Types of marketable securities. We have to just look after now the kind of marketable securities. Marketable securities available for investment can be grouped in several ways, but we can classify them under three broad heads, namely debt securities, equity securities, and contingent claim securities, which in turn can be grouped under several heads. We will give an overview of these securities below. The first one, we are talking about the debt securities. All debt securities represent a promise to pay a specific amount of money, the principal amount, to the holder of the security on a specific date. What is that specific date? The maturity date. In exchange for investing in security, the investor or holder of security receives interest. So there is a small promise, which is very prominent and very important. Why? Because it is giving you an idea that on a specific date, this amount will be given to them, the principal amount along with the interest. What could be the subheads? Market money instruments. The market for debt securities of relatively short maturity. We are going for the short-term investment only, therefore it is less than 1 year. It's called money market. The money market gives a considerable amount of liquidity to all participants in financial market. That is why we say that it is marketable securities. Immediately you can market it and cash them. Companies and government entities find themselves temporarily short of cash can raise funds quickly by issuing money market instruments. If suppose you have any short of funds, you can raise it by issuing money market instruments. Under this head, what is the subhead? Call money. The demand and time liabilities of a bank are evaluated every fortnight on a Friday called the reporting Friday. It is a mechanism. During the first fortnight following the reporting Friday, the bank is expected to maintain daily 4% of the demand and time liabilities as on the reporting day in cash with RBI. Okay, so this is one such mechanism which banks are following. Certificate of deposit. The certificate of deposit is an instrument issued by a bank or other depository institutions representing fund placed on deposit at the bank for a certain period of time. They are called negotiable certificates of deposit. So it is a certificate of deposit by the bank. They are also promising, but it is with the organized sector. So that certificate is called negotiable certificate of deposit. Commercial paper. Commercial paper is the term for the short-term promissory notes issued by the large corporations. Now, the other part comes with high credit ratings. Now, what is high credit ratings? Friends, when you are just there in the business, definitely you have to create the quantum of goodwill. If goodwill is good, if you have the goodwill in prominent, that prominence will be just giving you a sort of high rating in the market. So commercial paper usually carries no stated interest rate and sells at a discount from its face value as treasury bills. What is the objective? The objective of RBI introducing CP as an instrument to finance working capital needs and was to reduce the dependence on the corporates on banks. Next subhead is bankers' acceptance. Bankers' acceptance are time drafts drawn on a commercial bank for which the bank guarantees payment of face value upon maturity. They are commonly used to finance international transactions for the short term. So the bank is guaranteeing you, the other party, or maybe the other bank also, of the supplier, and there you are just getting the, say, assurance that on maturity you will be getting the fixed amount. Normally it is for the short term and for the international transactions. Government securities and securities guaranteed by the government. Government securities are public debt instruments issued by the government of India, state governments or financial institutions, electricity boards, municipal corporation, etc., guaranteed by the government to finance their project. Next head is capital market debt instrument. Now here the time is usually gets changed. Okay, usually it gets changed. Now the capital market supplies long-term funds. This is the first change to corporation, government entities, and other user of funds, other user of capital. The general type of debt instrument of the capital market is bond. Not like James Bond, but it is a bond between you and your banker, you and between the other giver. The bond usually pay interest to the holder once every 6 months, semi-annually, and pay the principal or face amount upon maturity. The subhead of this is government bonds. In India, both central government and various state governments are issuing bonds for diverse purposes with varying maturity periods. These bonds are issued by the governments to support various infrastructure and developmental activities, issuing bonds for large infrastructure projects such as construction of roads, airports, seaports, development of industrial parks has become common now. These are called government securities. So, issued by the government, and then there is a bond between you and the government. Municipal bonds. Municipal bonds are those issued by municipal authorities like government. These are the local authorities like the central and state governments. Municipal corporation and other local bodies are permitted to raise loans for their development. As per the Constitution of India, these are called local self-governments. What I said, the local authorities. Subject to certain restrictions, they are independent in designing their own activities. For financing their development, they can issue bonds or raise loans. The next subhead is public sector undertaking, the PSU bonds. They are somewhat the commercial organization of the government who are working for the services to the society. The PSU bonds are issued to finance projects of various public sector undertaking. What are those? NTPC, National Thermal Power Corporation, IRFC, Indian Railways, Finance Corporation, etc. So there are two kinds of bonds. One is tax-free with a coupon of 9% or 10% or 10.5%, and the taxable with a coupon of 13 to 18%. Now, if it is tax-free, definitely the interest rate would be lower. But if it is taxable, the interest rate would be higher. The public sector undertaking have been raising resources from the capital market through the issue of bonds termed as PSU bonds since a long time. So the commercial organization of the government are also raising funds like this. Corporate bonds. Now, the corporate means the other businesses. The debt securities of corporations with maturity of longer than 1 year are corporate bonds. Always just think of that whenever there is a sort of bond or a sort of long-term security, it would be for more than 1 year. The usual par value of corporate bond is rupees 100 and sometimes rupees 10,000. And maturities range from 2 years to as many as 30 years, depending upon the planning of the corporates. In recent year, however, corporate bonds issues have been of shorter maturities as inflation and economic uncertainties have caused investors to be less willing to commit their funds for a longer period of time. Now the customer also needing the investment for not more than 3 years to 5 years. 30 years would be a too long a time, therefore it is being discouraged or not responded by the customers or the investors. Equity investments, again the other domain of long-term investment. Equity securities represent the residual ownership of the firm. What is the residual ownership? Means the debt holders must first be paid off before the company belongs completely to the equity holders. Okay? Here once again we are having two types of equity security, are common stock and preferred stock. Common stock means equity shares. Let us just look at it. Common stockholders are the risk takers. They own a portion of the firm. That is not guaranteed. They are the last paid stockholders. They are the last in line with claims on the company's assets in the event of bankruptcy. But they have the beauty that they are the owner of the company. And thereby, they are supposed to take the risk, and that is why they are called the risk takers. Second one is, friends, the preferred stock. The preferred stock is technically an equity interest in the company, but characteristics are more like those of bonds. You are giving them some preference, so they are called the preference shares. Preferred means this type of stock has a stated par value that represents a claim against the corporate asset that supersedes the claims of common stockholders but is subordinate to the claim of bondholders. In case of bankruptcy, they will be preferred first, then the equity shareholders. That is why this characteristics is coming out to be like those of bonds. And the preferred stock, like preference shares. Contingent claim securities. Contingent claim securities. What do you do when you have the contingency plans? The contingent claim securities are securities that give the holder a claim upon another asset contingent upon the holders meeting certain contract conditions. Okay? So there is a claim on the other asset. What are those? Options. An option is a contract giving its holder the right to buy or sell an asset or security at a fixed price. All options are valid only for a specified time period after which they expire. So the holder is having the option. They have the right to buy or sell their assets or security at a fixed price. So this is a free option to the person for the contingent claims. Warrants. It is not like police warrants, but the warrants are like call options that are issued by the corporation. They give their holder the right to purchase the common stock from the corporation at a fixed price. Warrants usually have longer life than options, typically 5 to 7 years, although a few perpetual warrants do exist. These are not big in numbers, but whatever it exists, it's typically for more than 5 years and less than 7 years usually. Friends, next comes the convertible securities. How there is an edge above, there is one more secured facility they are availing. The convertible securities are securities that may be converted into common stock. A convertible bond is a bond that the holder may exchange for common stock of the corporation. So there is a condition. Future contracts. Now we are not talking about present, we are talking about future. It is again a kind of precaution you are taking normally in the international trade. A future contract is specifying that arranges the for delivery and payment of an asset at a future date is a future contract. Now, future contracts are traded publicly on the future exchange, and these exchanges have developed contracts on a number of assets such as corn, wheat, soybean, and frozen pork bellies. Let us understand what is the market for securities. Securities market can broadly be classified into short-term securities market, also money market, and long-term security market, which is called the stock exchange. Of course, the short-term securities are also listed, but most of the time the long-term securities are being traded. These markets, along with the banking and other financial institutions, are called capital market. Okay, that is why the stock market, the capital market, we just call it. Where different needs for money are exchanged, whether it is for short term or if the period is for more than 1 year, for the long term. It could range from 1 year to 3 years, 3 years to 5 years, more than 5 years, more than 10 years, 15 years, and so on. The first one is the money market. Money market is a place where borrower meets the lender to trade in money and other liquid assets that are close substitutes for money. Close substitute for money. It is very important. So you can encash them quickly. A developed money market will have a large number of instruments, both in terms of variety and volume, presence of large number of traders, and existence of requisite infrastructure to facilitate efficient settlement of transactions. Next market is market for long-term securities. Market for long-term securities is a place where borrowers raise capital for long term. Okay? Due to active secondary market for many of the long-term securities, there is no need that only investor having long-term surplus alone enter into the market. Okay? Even the bankers also, they are just coming forward. The third one is market for derivative securities, a comparatively new concept. So derivative market in India is relatively new and started developing since 2000. When NSE and BSE commenced trading in equity derivatives. Since then, derivative market in India has grown by leap and bounds. Actually, there are 4 types of derivative that can be traded in the Indian stock exchanges. They are equities, bonds, currencies, and commodities. Friends, for the market, once again, we are having certain models. The first one is Behrman-McAdams model. This model is different from other model because it assumes that investment in marketable securities is on account of raising excess funds from long-term sources. Buell model, it assumes that the demand for cash is continuous, which precisely yes, and frequent withdrawal of cash from investment will cost more. Therefore, the model gives an approach to find the optimal withdrawal of cash from investment. Okay? Optimal withdrawal of cash from investment. Baranek model, it is similar to Buell model, but the assumption here is different. Baranek model assumed that the firm disbursement takes place periodically, whereas the inflows are continuous. Since buying the securities also cost, the firm, it is not desirable to invest on daily basis. So you just collect the money for some time and then you invest it. Because even the buying of securities or selling them off also cost. Miller and Orr model. This model is based on control limit approach, According to the approach, the optimal level is first derived based on certain assumptions, and this optimum level needs to be disturbed only when the assumptions are violated. And the last one is Stone model. Bernal Stone suggested that instead of mechanically taking action on the basis of Miller and Orr model, Whenever the cash balance is breached the upper or lower limit, the treasurer can forecast the behavior of future cash flows of 2 or more days and use this information in taking investment decision. A pragmatic approach, a practical approach. Under this model, the firm sets out two inner limits, the upper limit and the lower limit. The upper limit when you find that this cash is excess, the lower limit when you ought to need the funds for your daily routine. Strategies for managing securities. What are these strategies? As indicated at the beginning of this unit, the financial managers need to have an understanding on different types of securities and the market in which the securities are traded before venturing into investments in securities. In addition to giving a fair amount of overview on the above two, we have also discussed different models useful in taking decision on investment in marketable securities. Using this set of information and knowledge, the financial manager has to design a strategy in managing securities based on the needs, based on the plans, based on the visions, and based on the model you are choosing to. Friends, with that, we have completed unit number 6. We are moving on to unit number 7, that is management of inventory. It is a kind of investment we have in the raw material, work in progress, or finished goods. As per the vision of the company, we invest, if we are the manufacturing, we invest in raw material. If we have the semi-manufacturing concern, or we are the assembler, we get these work in progress. And then if suppose we are only trading, then we go for the finished stocks. For the management of inventories, 3 things will come to the top of your mind when you think of manufacturing unit: machines, men, and material. Men using machines, tools convert the material into finished goods. The success of a business unit depends on the extent to which these efficiently managed. So what are the components of inventory? Raw material are the input that are used in manufacturing process to be converted to finished goods. The first one. Second, stores and spare parts. The store, or otherwise called the purchase component, are another important input in the manufacturing process because they have the major component of working capital used in assembly type of units. Next one is work in progress. These are items which are partially assembled or processed. The complexity of production process and time required to complete production cycle determine the value of work in progress. It may so happen that sometime when you are just finishing the month, not all the raw material is in final shape. And that is why it is called work in progress. You may have certain final products which are called finished goods. You may have certain goods which are yet to be finished, and the QC is to be carried out for those. So those particular items should be called work in progress. And then last one is the finished goods. The last stage in inventory processing is the finished goods. These are the final output in any manufacturing process and are ready to be sold to the customers. Now, why do we need inventory? Why do we need raw material? Why do we need work in progress? Why do we need? Because once we are just doing the business, we need some product to be sold. This is the primary thing we have to just know about. But there are certain other things we can just look after. The following are some of the primary reasons or the motives for holding inventories that applies to different components of inventory. The first one is transaction motive. If you are doing the business, the first and foremost job of yours would be the transaction to be done, both for product and services. So it is possible for a hotel to buy vegetable and other food ingredients required for the day and serve the food such that there is no inventory at the end of the day. Hygienic considerations. Thus, an important motive for holding inventory is to perform smooth transaction in the production process and serving the customer's demand. It makes production and delivery scheduling a lot more easier. If you have the inventory, you can serve them well. If not, it would be time-taking process and the credibility would also go out. Thereby, it is just going for the precautionary motive. Now, there is a risk of planning inventory exactly to the requirement. Because sometime in the seasonal consideration, you are just finding it that the customer's inflow is very big. But when the season is out, you may not be known about the customer's inflow. So it would be a risk of planning inventory exactly to the requirement unless the supplier is next to your firm. You may not be known to, but if the supplier is next door to you, it is easier. You can just call them and can just get the raw material. But otherwise, or the product or component is internally produced. Maybe you may be having these components indigenously produced. You may be producing all those internally. But if a firm buys material from outside, there are several factors that govern the smooth flow of completing the purchase orders. Some amount of excess inventory, often called as buffer stock, is maintained as a precaution. Some kind of things you have to just keep it as buffer stock so that any number of things, any number of inflow you can face afterwards, but the buffer stock, the minimum thing, you have to just keep it as precaution. The precautionary motive plays a vital role in decision making relating to spare and other critical items required for the production. Next one is speculative motive. Though firms may not speculate in buying or selling raw material, there is nothing wrong in exploiting the opportunity that arises occasionally due to uneven demand and supply. What is the example? A refinery could buy or enter into a contract for the purchase of crude oil when the price is cheap because the sudden increase in the supply of oil. In the recent past, the Indian government has entered into a contract with Russia because of the raise in the price because of the war situation in the Gulf countries. So this kind of speculative motive, they have entered into a contract because the oil, the price is cheap and sudden increase of supply in the supply of oil was ascertained by the Indian government from Russia. Friends, the above discussion presents general reasons for holding different types of inventory. We are giving you the specific reasons as well apply to individual components of inventory. Raw material and stores. To make them easier, definitely, if you have the raw material, your production process shall be easier. To ensure price stability, the cost of the unit should be stable if you are having a buffer stock. To hedge against supply shortages, you are sure about that there will be no shortages. You have already made the provision against those. And A continuous process of production shall take place to take advantage of quantity discount. Friends, when you are taking the goods in bulk, definitely you are getting the quantity discounts as well. So it would be a cost matter. If suppose the items are not perishable, you can always use this particular opportunity. Work in process to achieve flexibility in manufacturing, because we are not bound to just go for the finished goods all the time. Even if it is, say, at some stage, we can assume our charge in the next cycle whenever the break is over. And then the ensure economics of production. See, till whatever time you have used, if you can make some other products, maybe in semi-finished stage, you can do that. And finally, the finished goods, which gives you a specific reason to ensure smooth delivery schedule. You can entertain, you can just attend to your customers if you have the stock in hand. To provide immediate supply, that's the next section. To achieve economics of scale, in case the big customer is coming and they are asking for a bigger, say, supply, that also you can just make and can get the economics of scale. To allow batch processing in a multiple product situation, optimize the utilization of machine and other resources. Friends, a very good example you can find in China, that they are producing the mobiles. They are just preparing the batches, and where the machine works for 24 hours. And then in all the shifts, you are producing a batch. You are making the optimization of the machine and other resources. Of course, in Indian subcontinent also, there are certain companies, there are certain factories where we are using this model. Though the above said factor could influence the firm in maintaining the inventories, each firm has its own policy. Now, there is a turn. Each firm, they have their own policies. They can just follow all, maybe few, or maybe none. So they can decide the quantum of the inventory to be maintained. To understand the need for inventory, one should understand the flow of inventory component in the manufacturing process. How do we just prepare or create the inventory system? An understanding of inventory system is essential before making any attempt to manage different components of inventory. What do we do? A system in simple terms is defined how things are organized together with their interrelationship among us different components of systems. We can define inventory system as the one which consists of three components. What is that? Inventory, customers, inventory storage points, and inventory sources. So these are the three major components in the inventory systems. Where is inventory? Customers are the prime cause for investment in the inventory, because they are the people who are giving you a reason for trading, manufacturing, keeping the buffer stock with you. Inventory customers include the end customers, marketing department or dealers, production centers, or anyone who demands inventory to be stored for their ready consumption. The second component in inventory system is inventory storage or inventory stocking points. Now it comes out about the store part. It might be a warehouse or distribution center, a storage bin for any other physical location where inventory is stored for a brief period of time. Stocking points are required because transportation in bulk quantity to these points is easy and cheaper, and stocks are redistributed in smaller quantity to retail outlets. So this is about the storage part. And the last component of an inventory system is sources of inventory, where from you are purchasing your raw material or semi-finished goods for assembling or finished goods for trading. It could be a supplier from whom the firm purchased material or internal division from which the products are transferred, either internal or external sources. This factor affects inventory management in several ways. For instance, the number of inventory sources affects the decision on inventory holding. If you have the internal sources, definitely you can hold the minimum inventory with you. But if you have the external sources, definitely you are to just make out a decision looking into the processing time in receiving the material ordered. Cost in the inventory system. Managing cost is one of the primary responsibilities of any manager. The focus is not to eliminate or minimize the cost, but it is a comparison of cost and benefit. The focus is to minimize the cost per unit of benefit. Thus, modern inventory management shifted the focus from eliminating inventory to optimizing the level of holding inventory. You are not eliminating the inventory, but you are optimizing of holding inventory. How much? When? There are 5 different costs to the firm that holds inventory. The first category of cost is the value of inventory itself. It is the purchase cost of inventory of material and components. The second component of inventory cost is the cost of acquiring inventory for materials and purchase parts or components. It's the cost of purchasing freight, inspection. This subsidiary cost. This component of cost goes up when the material are purchased in small lots. Because every time you will be just needing the freight and inspection, other possibilities added to. Because it requires frequent ordering, transportation, and inspection. The third cost of inventory, which is important amongst different components of cost, is the cost of holding inventory, the warehouse, and other related maintenance expenses. There are different types that go into the cost component. Some of them are fixed in nature, and many other are variable. The cost of maintaining and managing stores, warehouse, and other storing facilities are part of cost of holding inventory. The losses such as spoilage, theft, or obsolescence that might occur in holding the inventory are also included in the cost of holding inventory. Friends, the most important cost of holding inventory is interest or opportunity cost associated with the locking of firm's funds for inventory. How much interest you are paying, this is also one paramount or important component, because till such time you are holding that inventory with you, the interest cost shall also be one of the component. The fourth cost is invisible. Now, these 3 costs were visible. You could just look at. But if you just go for the fourth cost of inventory is invisible and is often ignored in formal analysis. Normally, we just don't look at, therefore we ignore it. But the intelligent manager looks into it and then make a focus on that as well. This relates to the cost of inventory shortage. Now, whenever there is a shortage of raw material, by the time how much customers you lost. This is the most difficult category to estimate, even though it is very important cost to the firm. This difficulty is mainly due to the changes in the magnitude of the cost in different situations. Okay. The last component of cost related to inventory is cost of managing the inventory system. The cost of developing inventory information system, computer hardware, software, and people associated with managing the inventory system. Again, this is a, say, subsidiary cost, yet important because you get the information proper from these people and then you make a decision. The cost is high in a multi-product and multi-location firm, whereas it is relatively low for a single product company produced at a single location. Wherever you are spread, the cost would be more. Means if suppose you are at a single location, single product, you will be having a lesser cost. Friends, the above cost in inventory system can also be classified as follows. The cost directly proportional to amount of inventory held as shortage storage cost, financial cost of carrying inventory, cost not directly proportional to the amount of inventory held, which can again be classified into the following two categories. Okay. Cost directly proportional to the period of holding inventory such as spoilage, obsolescence, interest cost, etc. Cost directly proportional to number of orders such as ordering cost, setup cost, freight payment process, etc. And the last one is stock out cost. The objective before us is to manage these components of inventory cost such that the value derived from the inventory is maximized. The optimization can be achieved with the zero inventory or high inventory, ordering frequently, procurement and procuring from several sources or storing in bulk and taking huge or zero risk of stock out position. Friends, how do we just organize the optimizing of inventory cost? The inventory holding is desirable because it meets several objectives and needs. But excessive inventory is undesirable. Why? Because it costs a lot to the firm. The issue before us is balancing the cost and benefit and get an optimum level of inventory holding. This optimization is achieved in two stages. First, the optimum ordering level, also called the reorder level, is computed by using the time required to place the order and receive the goods and demand from production centers. Second, the optimum ordering quantity, also known as the reordering quantity or economic order quantity, is computed using inputs such as ordering cost and inventory carrying cost. In simple terms, two questions, namely, how much should be ordered and when should the stock be ordered are to be answered. Economic order quantity, since the trial and error approach involves two-step tedious calculation, one simple method is the use of formula for calculating the economic order quantity. Analysis of quantity discounts. There are occasions when the firm is able to take advantage of quantity discounts, provided the order size reaches a certain level. It is possible to analyze and decide on such cases. Buffer stock decision. Many firms maintain, say, some margin of safety or buffer stock. If they did not do so, they would run the risk of being unable to meet the demand for an item of inventory at a particular point of time. The cost of incurring shortages in the opportunity cost, one must take into account when finished goods are in short supply, customers get irritated and loss of business may result therefrom. When raw material or in transit inventories are in short supply, stoppage of production and resulting inefficiencies may crop in. To decide the level of buffer stock to be carried out, a firm must balance the cost of stock out with the cost of carrying additional inventory. One can assess this balance if the probability distribution of future uses is known. Selective inventory control models, stock levels, reorder level. The storekeepers start to make the purchases when the inventory in stores reaches this level. The reorder level is fixed, taking into consideration lead time and unusual delays or interruptions. This calculation is as follows. Reorder level is equal to maximum consumption multiplied by maximum reorder period. Minimum level, inventories are not allowed to fall below this level. Okay. So how do you just go for minimum level? Reorder level minus normal consumption into normal reorder period. What is the maximum level? The maximum level is just talking about the highest level beyond which the holding of inventories implies blocking of funds. So you have to stop that. So how do we calculate maximum level? Reorder level plus 0.5. This is the margin. Reorder level quantity minus the minimum consumption into minimum reorder period. What is the danger level? The level is fixed even below the minimum level as a disastrous signal. Reorder point, when the question of maintaining inventory at the optimum cost is raised. One should not only focus how much to order, but firm should also concentrate and when the order has to be placed. ABC analysis work on the mechanism, namely always better control. And for the weight analysis, it stands for vital, essential, and desirable. For the FSN analysis, inventory items are to be classified and controlled on the basis of fast moving, slow moving, and not moving. And now we are to look at the inventory management under uncertainty. The issue is how to address the uncertainty in demand while deciding the optimum level of inventory. We'll discuss few models available to address the issue. Option pricing model is the first such option. Risk adjusted discount cash flow, the dynamic inventory model, and these three models are just giving you the idea how to just say come out in the uncertainty. We have the emerging trends in the inventory management where we have the adoption technique with the say evolvement of the technology and e-commerce. We are finding it that the informations are proper and are coming fast so as to take a decision therewith. Quickly, we are just shifting to financing of working capital, theories and approaches. The present block issues governing the determination and also the practices followed by the bank and other financial institutions. Major concentration has been on the following. What is the objective function in taking working capital decision? How to create value through working capital? Is there any scope to lay down time-tested principle of working capital policy? How do risk-return relationship operate in the era of working capital decision making? Creation of value through working capital management. Creation of value has been said to be objective of a company. In the realm of finance, it turns out to be function of firm's investment, financing, and dividend decision. In addition to long-term investment decisions, companies face many decisions involving investment in current assets. Quite often, maximization of profit is regulated as the proper objective of the firm, but it is not as inclusive as that of maximization of shareholders' value. A right kind of approach of decision of investment and financing of working capital can contribute to the achievement of objective functions. So what are those approaches? Approaches to working capital investment. One is the Walker's approach. The other one is trade-off approach. Early in 1964, Ernest W. Walker has developed a four-part theory of working capital. He has laid down that a firm's profitability is determined in part by way its working capital is managed. When the working capital is varied relative to sales without a corresponding change in production, the profit position is affected. If the flow of funds created by the movement of working capital is interrupted, the turnover of working capital is decreased, as is the rate of return on the investment. In this regard, Walker has laid down the following four principles with regard to the working capital investment. The first principle, this is concerned with the relation between the levels of working capital and sales. His principle is that if working capital is varied relative to sales, the amount of risk that a firm assumes is also varied. An opportunity for gain or loss is increased. This implies a definite relation exists between the degree of risk and management assumes and rate of return. The more the risk the firm assumes, the greater is the opportunity for gain or loss. Second principle, capital should be invested in each component of working capital as long as the equity position of the firm increases. The third principle says the type of capital used to finance working capital directly affects the amount of risk that a firm assumes as well as the opportunity for gain or loss and the cost of capital. The fourth principle says the greater the disparity between the maturities of a firm, short-term debt, and its flow of internally generated funds, the greater the risk and vice versa. Second one is trade-off approach. It is evident from the study of Walker's principle that working capital decision involves a trade-off between the risk and return. The same is sought to be further examined in this section. Friends, all decisions of the financial manager are assumed to be geared for maximization of shareholders' wealth and working capital. Decisions are no exception. Accordingly, risk-return trade-off characteristics each of the working capital decision. There are two types of risk inherent in working capital management, namely liquidity risk and opportunity loss risk. Liquidity risk is the non-availability of cash to pay the liability that falls due. Even though it may happen only on certain days, it can cause not only a loss of reputation but also make the work condition unfavorable for getting the best terms on transaction with the trade creditors. The other risk involved in working capital management is the risk of opportunity loss. That is risk of having too little inventory to make production and sales, and the risk of not granting adequate credit for realizing the risk of achieving level of sales. In other words, it is the risk of not being able to produce more and sell more or both, therefore not being able to earn the potential profit because there are not enough funds to support higher inventory and book debts. Thus, it would not be out of place to mention that it is only theoretical that the current assets could all take zero values. Indeed, it is neither practicable nor advisable. In practice, all current assets take positive values because firms seek to reduce working capital risks. Approach to financing working capital. Financing the firm's working capital requirement has been shown to involve simultaneous and interrelated decisions regarding the firm's investment in current assets. Fortunately, there exists a principle which can be used as a guide to firms' working capital finance decisions. This is hedging principle or matching principle. Simply speaking, the hedging principle involves matching the cash flow generating characteristics of an asset with the maturity of the source financing used to finance its acquisition. For example, a season's expansion in inventories, according to the hedging principle, should be financed with a short-term loan or current liability. The rationale underlying the rule is straightforward that funds are needed for a limited period of time, and when the time has passed, the cash needed to repay the loans will be generated by the sale of extra inventory items. Obtaining the needed funds from a long-term source Longer than 1 year would mean that the firm would still have the funds after the inventories they helped finance have been sold. In this case, the firm would have the excess liquidity, which they either hold in cash or invest in low yielding marketable securities until the seasonal increase in inventories occurs again and the funds are needed. This would result in an overall lowering of firm's profit. Friends, what are the effects of choice of financing on ROI? A firm can reduce its risk of illiquidity through the use of long-term debts at the expense of a reduction of its return on investing funds. Once again, we see the risk return trade-offs involves an increased risk of illiquidity versus increased profitability. Friends, with that, we have completed our third session on working capital management. We will start with the fourth session next time. Thank you so much. Namaskar.